Hello traders, Gary Wagner here. It is approximately 11:36 in Honolulu, 5:36 in New York on Monday, May the 9th, 2022, and this is the Daily Report for gold and silver. The financial markets continued their brutal sell-off with the Standard & Poor's 500, the Dow Jones Industrial Average, and the NASDAQ Composite all experiencing major declines. S&P dropped 3.2% in trading today, and if this trend continues throughout the week, as you can see in this weekly chart, it would mean that we have seen U.S. equities sell off for 6 consecutive weeks. They are now on their 5th consecutive week of closing lower than the previous week. That, of course, has spread across all financial markets, with yields remaining strong in U.S. debt instruments and the precious metals selling off briskly. Gold lost 1.59% today. That's a $29.10 decline. This bases the most active June contract, and the June contract is currently fixed at $1,853.70. The only precious metal to actually show any kind of rise was palladium today, gaining about $50, and the most active futures contract is still well above 2,000 at $2,073.50. The dollar, in terms of the dollar index, was neutral, but it did trade to a higher high than we have seen. You can see that on this daily chart here. It closed right at the current level of resistance we have identified at 103.73, but all bets are off as to whether or not the dollar will continue to rise, and that will be based upon the release of last month's CPI inflationary index that will be released this Wednesday on May the 11th. This first chart is a 60-minute candlestick chart of gold futures. We can see that the high that occurred in gold, which came in at 1885.60, occurred early in the trading session overseas yesterday in Australia, Hong Kong, and London, and started to tick aggressively lower throughout the day. In fact, the low that came in today at $1,851 occurred during this last hour. Although this daily candlestick chart shows that gold is currently at 1858.80, you can see from the 1-hour chart that we had up previously that we are looking at gold lower. As I said, currently fixed at 1853.70, which puts us right at the first level of potential support, and whether or not this level holds over the next couple of days, I believe will be dependent upon the numbers that are reported during Wednesday's release of last month's Consumer Price Index. The forecasts are coming out mixed, with some sources looking for an abatement in inflationary pressures. According to Forbes, they could come in anywhere between 8.5 and 8.1%. However, that differs from a report in Bloomberg Markets, in which they are sourcing their information from a New York Fed survey, saying that we will see inflationary pressures not abate and continue to be hot, possibly rising this month and over the next year. Which brings us to our technical analysis of potential levels of support. Of course, as we said, we believe $1,853 per ounce is an important level, but it's simply based upon this recent top that came in around the middle of January. Below that, we have to look at the 200-day as being a critical area that gold needs to hold if we are to say that gold on a long-term basis still could move back to a bullish mode. That occurs at $1,836, so a little bit under $20 from current pricing, and below that is a longer-term retracement set that we have been using, with the 50% retracement coming in at $1,820. Those are the key levels we want to watch if, in fact, gold breaks below $1,853. We have remained neutral with no active trades in gold or silver, and we believe that the best action is to continue to have no active trades on, as this market is much too volatile, and there is certainly the opportunity for lower pricing. But as I said, it will be about the CPI report on Wednesday that will shape the future direction not only of gold, but the financial markets as a whole, as they've experienced such a dramatic decline over this last month. This has been Gary Wagner wishing you, as always, good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.